After months, if not years, of pushing for GST cut on life and health insurance premiums, it seems now that the next-gen GST or GST 2.0 reforms that Prime Minister Modi announced on Independence Day may not do much for the insurance sector. If anything, it might just work in the opposite direction. While the understanding has been that GST on insurance premium would get cut from 18% to 5% or even potentially get slashed to 0%, insurance veterans are voicing concerns that a lower GST rate would deny the industry from seeking input tax credit or ITC, and that could mean more than offset for the savings on tax that these companies may get. Now, in effect, this means a lower GST rate on insurance premium could at best keep insurance premiums static and at worst make them more expensive for consumers. Let's understand how and why with Ritesh Kanodia, partner Aurtus Capital, who joins us this morning. Good morning, Ritesh. Pleasure having you here with us on News9. Just put this entire conundrum into perspective for us. At one point, there was this debate that GST should be cut on insurance companies so that the premium becomes cheaper and more affordable for consumers. But now there are industry voices which are raising the concern that if GST is lowered to 5% or even slashed to nil, the input tax credit goes away, and that means insurance premium costs could at best stay the same, if not get more expensive.
Yeah, hi, good morning. So what happens is that when insurance companies pay GST on the insurance premium, which is at the rate of 18% currently, what they also do is parallelly take offset of all the credits on expenditure that they incur, because this is a service entity. They would have huge amount of infrastructure cost, IT cost, marketing cost, etc.
Right.
So the net effective rate ultimately culminates into an output of 18% GST.
Sure.
But let's take a situation where GST is brought to 5% and with no SENVAT credit, no GST credit, I mean to say. So if that be the situation, which means that they will charge 5% on the output, however, the input services of 18% would not be available to them. So the effective rate of tax would actually go up because it is 5 plus whatever is the GST on the input services. So that could be one scenario. And another scenario could be, let us say it is at 5%. And let's say, and I was just looking at the screen on the middle path, let's say government allows them the credit. Now, again, over here, what could potentially happen is that 5% GST on output will not be able to offset the full GST on the input services of 18% that they will get. So which would then lead to an accumulation of credit in their books. And some cost of that accumulation would definitely be passed on by the insurance company. So yes, it really depends upon how the government comes out with this 5% rate of tax, with credit, without credit, and what happens to the accumulated credit. Let's say if it is with credit, will the government allow them the refund of the input services that are accumulated? I must just tell you that currently inverted duty structure accumulation out of services is not allowed by the government. So that's the entire conundrum which the companies are facing, and that's where the request was to take it at 12%. But now there is, I don't see that there is a 12% in the picture with the rate slab rehashing.
But Mr. Kanodia, for the sake of argument, it seems that all the costs, like you mentioned, the infrastructure cost, the marketing cost, all other overheads that insurance companies would incur would pretty much stay the same, whether it is taxed at 18% or 5% notwithstanding. The point being that if those services or those external vendors are still providing services to insurance companies, then ideally, should an input tax not be given on those services or on those goods that they purchase from the market? And hence, an 18% being cut to 5% should actually just lower the premium cost for the consumer.
You're right. If the 18% can be fully offset against the 5%, see the delta, right? Let us say my insurance premium is 100 and I pay 18% today at 18 rupees, which means I have more than sufficient tax liabilities to offset that input service cost, right? Now that slashes to 5%. My input services credit could still be higher, right? Because let's say I take services of 80. I'm just assuming a number, and 18% of that would be 9.6. The 4.6 becomes an accumulation.
Right.
Now, there could be how do they exhaust that accumulation? If they have some other tax liability, that is fine. But let's say if they do not have any other tax liabilities, which means they will have to carry this forward. And at some point in time, the auditors will start questioning the input tax credit, saying where is the focus of potential of utilization. Unless that 4.6 that we are talking about is granted to them as a refund by the government, which is not the case today. So this is a situation again where we are talking about GST at 5% plus ITC. Take a situation of GST at 5% plus no ITC, which means your 18 on the your 5 on the output plus 80 into 18%. That is the total effective cost, whatever
Right,
that number comes to.
right.
So that's how the entire fungibility of credit scenario works.
So what can be done, in your expert opinion, Mr. Kanodia, what can be done to indeed bring insurance premiums down? Because this has been a debate which has been raging for so long now. And up until very recently, the understanding was that a GST cut will do the job. Now that we are learning that the GST cut will not do the job, what will do the job of bringing down insurance premiums, especially on health and life insurance, sir?
Ideally, 12% was an ideal scenario. Now we do the 12% slab per se is not going to be there. So let us say we go at a 5% rate of tax, and clearly input tax credit will have to be allowed. Otherwise, there will be a rate enhancement. Uh, Again, the government could consider granting refund of input services, which is getting accumulated. That will actually bring down this entire scenario to a actual factual reduction of 13% straight away to the consumer.
So in the
So
interest
that
of the
could be
consumer, sir, do you think the government has the wherewithal to allow this input tax credit to insurance companies and the refund that you mentioned?
the entire debate has been that insurance is important for the country, right?
Right.
Because the insurance penetration is very low. So therefore, if that is the social objective of the government, then clearly, that could be the way forward, and there may be some cost to the government arising out of the same. So keeping the social objectives in mind, maybe that could be the approach that the government may adopt in this particular scenario.
And will
Uh,
that decision be taken by the group of ministers or will it be taken by the GST Council, sir?
No, it would be by the GM because the states have to be participant to that decision making, and if the state do not agree, then clearly it doesn't go forward. But this debate has been going on now for quite some time, and hopefully we'll see some closure in the next GST Council meeting. See, there is another aspect which could happen is they may actually lower the rate only for uh, certain premiums which are below a particular amount.
All right.
So for low policies or for senior citizens, right? Let's say I take a term policy which is a very big amount, right? They may
Right.
not lower the rate for that possibility. So they may also come with a threshold like what we have in a five-star hotel, where
Right.
if it is above 7,500, the rate goes to 28 if it is below. So
Right.
they may also
Or
come
for business class tickets and economy class tickets on airlines where there are different rates that
absolutely.
are commanded.
Yeah. Again, that is going under rate rejig where
Right.
there is a discussion on bringing business and economy rates at par. But
Right.
yes, and I think this could be a better scenario where if my premiums, if my policy amounts are, let's say, below a particular threshold, I go to 5%. If they cross a particular threshold, then I go to 18. And of course, full credit in both scenarios.